Welcome back, ladies and gentlemen. In our last class, we explained who is accountant, what they do, and what is accounting. And we said that accounting is the process of recording, summarizing, analyzing, and reporting financial transactions of individuals, businesses, or organizations. It involves the systematic and detailed recording of financial activities, followed by the preparation of financial statements and reports to provide accurate and relevant information for decision-making, regulatory compliance, and stakeholder communication. We also agreed that in this lesson, we'll talk about the process of recording transactions and the accounting process. However, I want us to understand accounting from the end result, which is financial statements, before we move into the accounting process. This will give the whole picture of accounting before we get into the accounting process. We had mentioned one of the roles of accountant is financial reporting, which is preparation of financial statements. Let us understand the meaning of these financial statements, and from there we will get to understand the process involved in arriving in these financial statements. In accounting, when we talk about financial statements, we mean income statement or profit and loss statement, balance sheet, cash flow statement, and equity statement. Profit and loss statement is a statement that shows the financial performance of a business. When we talk about financial performance, we are referring to whether business made a profit or loss during a given period, say a given month or a given year. So the performance statement will show whether revenue received from customers were more than the expenses, such that the business ended up with a profit, or the expenses were more than the revenue from customers and the business made a loss. This is what we mean by financial performance. In later chapters, we'll get to know more about income statement or profit and loss statement. When we talk about balance sheet as a financial statement, we mean that statement that shows the financial position of a business or entity. So, this statement will show us the value of assets, liabilities, and equity or capital at the end of a given period or at a particular moment in time. If you don't understand the meaning of assets, liabilities, and equity, don't worry, we will explain them shortly. For now, just know that the balance sheet statement is a statement that shows the financial position of a business. The cash flow statement is a statement that shows how money flows into and outside the business and what remains after given period. For example, in a business you might have $1,000 as cash at the beginning of 1st January, and at the end of January 31st you might have $15,000, the statement of cash flow will show how you started with $1,000 and ended with $15,000 at the end of the period. It will explain money received and from where, money spent and on what expenses, how much balance at the end of the period. The statement of changes in equity is a statement showing what was the value of the owner's capital at the beginning of accounting period, what happened in between the beginning of the period to the end to arrive at the equity balance at the end of the period. Were there dividends to shareholders? Were there profit or loss that was transferred to shareholders' equity? How do we arrive at these financial statements? For an accountant to reach at the point where he or she can prepare the financial statements, there is a counting process that is followed. The process starts from source documents, then followed by journal entry, then ledger accounts. Next is trial balance, then finally the financial statements. In this process is where the accounting staff is done. Accounting begins with source documents, which are the original records of transactions. These documents include things like receipts, invoices, bank statements, and purchase orders. For example, when a company buys supplies, they receive an invoice from the supplier. This document serves as evidence of the transaction and is used to record it in the accounting system. Once we have the source documents, we record the transactions in a journal. A journal is like a diary where we write down all the transactions in chronological order. Each entry in the journal includes the date of the transaction, a description of what happened, and the amount involved. For example, if a company buys supplies for $500, we make a journal entry to record the purchase. After recording transactions in the journal, we post them to ledger accounts. A ledger is like a big book that contains all the accounts for a company, such as cash, accounts receivable, and supplies. Each account has a separate page in the ledger where we record all the transactions related to that account. For example, we would post the $500 purchase of supplies to the supplies account in the ledger. Once all transactions have been posted to ledger accounts, we prepare a trial balance. This is a list of all the accounts and their balances, either debit or credit, at a specific point in time. The trial balance helps us ensure that the total debits equal the total credits, which indicates that the accounting equation is in balance. It's like a checkpoint to make sure we've recorded everything correctly before moving on to preparing financial statements. Finally, we use the information from the trial balance to prepare the financial statements. These include the income statement, balance sheet, cash flow statement, and equity statement. The income statement shows the company's revenues and expenses over a period. The balance sheet shows its assets, liabilities, and equity at a specific point in time. And the cash flow statement shows how cash flows in and out of the company. These statements provide valuable insights into the financial health of the company and are used by investors, creditors, and other stakeholders to make decisions. So, in summary, accounting starts with source documents, which are then recorded in a journal, posted to ledger accounts, and summarized in a trial balance. From there, we prepare the financial statements to communicate the company's financial position and performance to stakeholders. But before we dig deeper into the accounting process, let us understand the elements of accounting, which are usually 5. So, the elements of accounting are asset, liability, revenue, expense, and equity. Let's try to understand the meaning of each element. An asset is a resource which has value and is owned or controlled by a business to generate future economic benefit. Let me repeat again. An asset is a resource which has value and is owned or controlled by a business to generate future economic benefit. The asset must have value. It must be owned or controlled by the business to generate future economic benefit. This can be cash, inventory, or equipment. For example, a business can use cash to buy some items or inventory, which are later sold to customers at a profit. So, the business is controlling cash to generate future economic benefits. When we talk about liability in accounting terms, is that what a business or entity owes to the outsiders that needs to be paid in future as a result of past event? Example, is a loan taken from a bank that will be paid in future is a liability. So, the past event here is when there was an agreement between the bank and the business, and the loan was given. This loan will be paid in future, and this makes it a liability. Revenue is the inflow of cash or amount yet to be received from customers after selling the goods or rendering a service. When we sell goods or do service to a customer and wait to be paid later, we call that receivable. So, revenue is inflow of cash or receivables from customers after selling the goods or services. When we talk about expense, we mean that cost that has already been incurred to generate revenue with no future economic benefit expected from it. Take an example of a sales agent. After selling goods or items in the month of January, we need to pay him salary for the items sold in January. So, in the period of January, the business has incurred an expense sales agent salary, which needs to be paid but has no future economic benefit in the coming months since the expense was for January. In February, the expense becomes a liability, so long as it stays unpaid for some time. Lastly, we have equity, which is money owed by the business to the shareholders or owners of the business. We also say that it is the residual value of assets after paying off the liabilities. So, when a business pays off all its liabilities from the assets, the amount that remains to be given to the owners of the business is called equity. We also call it capital, that amount that the owners of a business put into that business to start operations or when it is operating. Now, we understand the elements of accounting. However, before we go back to the process of accounting, where the real magic happens, we need to understand the accounting equation and the double entry concept, that is, the debit and credit. So, we will start by understanding the double entry concept or the duality principle. So, what is double entry in accounting? The double entry concept, also known as the duality principle, is a fundamental accounting principle that forms the basis of the entire accounting system. It states that every financial transaction has two equal and opposite effects, which are recorded in at least two different accounts. Let's make it simpler to understand by understanding two sides of a transaction. Every time a transaction occurs, there are at least two parties involved, and each party is affected in some way. For example, when a company sells a product, it receives cash, an increase in assets, but also gives up the product, a decrease in inventory. Both sides of the transaction must be recorded. The recording of both sides of the transaction is done by debits and credits, or by double entry accounting. In double entry accounting, we use debits and credits to record these two sides of the transaction. Each account in the ledger has a normal balance side, either a debit or a credit side. For example, asset accounts have a normal debit balance, while liability and equity accounts have a normal credit balance. The double entry system ensures that the accounting equation, assets into liabilities plus equity, remains in balance after each transaction. This means that the total debits must always equal the total credits. In manual accounting or traditional accounting, the debits and credits are clearly explained by T accounts, where the left side is the debit side and right side is the credit side. Let us try to understand it with an example. Let's say a company buys $500 worth of inventory on credit. This transaction would be recorded as follows: debit inventory, an increase in assets for $500. Credit accounts payable, an increase in liabilities for $500. In a computerized system, the same is recorded, and the difference being that there is no manual bookkeeping, as the recording is done through the accounting system. By using the double entry system, accountants can verify the accuracy of their records. If the debits and credits do not balance, it indicates an error in recording the transaction that needs to be corrected. In summary, the double entry concept ensures that every financial transaction is accurately recorded by recognizing that every transaction affects at least two accounts, with debits and credits balancing each other out. This principle forms the foundation of accounting and provides a systematic way to track and analyze financial information. The 5 elements of accounting will be affected differently with debits and credits as shown on the table. We will see this practically when we dive deep into the accounting process, when we will be doing the recording transactions. So, don't worry if it is still not clear with the debits and credits, as we will do this practically. The accounting equation, assets, liabilities plus equity, forms the basis from which balance sheet is prepared, where all assets at any given point in time must equal liabilities plus equity. Ladies and gentlemen, that was for this lesson. And in our next lesson, we will dive deeper into the accounting process and see how the magic happens. Thanks for being part of the lesson, and see you in the next lesson.